What's up, everybody? Eric here. Welcome back to All the Outliers. We got David Hunter back for another edition of the Outlier podcast. And we were actually just talking for like 15 minutes about the markets and the economy. There's no shortage of interesting things going on. But first, welcome back, David. Great to have you.
Yeah, hi, Eric. Thanks for having me back.
Yeah, of course. So, I mean, I figure we could just pick up literally what we were just talking about, kind of the recent market behavior today. You were talking about the sell-off that we saw today and kind of how that juxtaposes against the term lows over the last week or so. Just wondering, what are you making of the continuation of the pullback? Do you think that there's a lot of velocity behind this, or are we slowing down?
Yeah, I'm guessing. I mean, yesterday looked pretty good, and I had made a call last Friday that it was possible, looked pretty good possibility that we had made the lows Friday morning. Um, and the follow through this week kind of said that was right on. The weakness today, and particularly how it ended the day, it almost looks like you might have a very short term head and shoulder top and could go down to 4,200. So we'll find that out, I think, probably tomorrow, Monday, whether we sell off or whether we turn around and head back up. But that's all it is, really a question of whether you got to go a little lower in this pullback or whether the pullback lows were seen last Friday. Beyond that, I think once this pullback runs its course, if it hasn't already, I think we're off to the new highs. And from there, I think we keep on going. So, I still have that melt up forecast for this fall. I still think you're looking at 6,000 to 7,000 on the S&P, 20,000 on the NASDAQ, 48,000 on the Dow. So, my upside is not changed. It's really just short term. Are we done with the pullback, or are we going to see more? And what's interesting in this pullback of up till now has been a 5% pullback in the S&P. Really turned sentiment around. You had a lot of people, and I had kind of suspected that as we saw the rally. You had a lot of people jump on the bullish bandwagon once we got up above 4,300 and headed for 4,600. A lot of those people that fought the rally all the way up from last October started talking more bullish. But my sense was they didn't have any conviction behind that bullishness. And that's been borne out in this pullback. A lot of them gave up the bullish view as soon as you had the tape turn south. So I think as we saw all, last fall into right up until now, I think an awful lot of people viewed any rally as a bear market rally. And now they feel that bear market rally has run its course and that we're heading back towards, whether we'll go back to the lows of October, whether we'll go partway back there. I think there's still a lot of skepticism about this market, and that's healthy. I mean, that's that wall of worry that I talk about. You need the fuel comes from people remaining skeptical, people fighting this thing. You don't want to see this, bullish conviction. So we certainly aren't seeing bullish conviction. The pullback's kind of that pause that refreshes. And I think it's just really a question of whether we go back to 4,200 or whether we saw the lows last Friday.
Yeah, it's interesting. And so thinking about the last time we spoke, about your kind of market hypothesis here, thinking still about that large market run up in the fall. Last time we spoke, I think we talked a bit about just the Fed and the Fed's role specifically in terms of their approach towards interest rates, right? Like if there was some sort of hint of a contraction in their target rate, that probably would fuel a big run. What's like the primary catalyst that you see for the primary run up that you're talking about here? I was looking at the Fed probabilities for the next FOMC meeting, which is for the 20th of September. And right now it's showing like a 80%, 80.5% probability of no change in the federal target rate, federal fund rate, and then a 19.5% probability of a hike. I'm curious, like, what are the primary catalysts that you see? Because it looks like the Fed, at least best case scenario right now, would be looking at another pause come September. So what other catalysts are you looking at?
Yeah, that's interesting. So first with the Fed, and of course Powell's speaking tomorrow, so we're going to probably get a even better handle on what the Fed's going to do in September. my guess is he's steady as she goes tomorrow. He'll talk kind of a balanced policy, say we feel like we're making good progress on inflation. We're not there yet, but we're making progress, and we also are worrying about, we have to balance that risk off against that inflation risk off against the risk that we've gone, that we go too far and tip this thing into recession. So with, you're getting certainly some indications this week that retail is struggling, that the consumer's starting to, pull back. And I think the Fed's very aware of that. You get all kinds of conversation out there about the Fed, or about the banking system tightening credit conditions, and you're seeing lending slow down. Obviously, we have mortgage rates up at 7.5%, and that's going to slow housing no matter what. So they are aware that they have to be, that they have to be careful not to go too far and tip things into recession, or get things going on the downside too fast. On the other hand, they don't want to, declare mission accomplished, because inflation is not yet there. And interesting, in the last few weeks, you were getting the sense the street was starting to gravitate towards maybe inflation is going to pick up again, because some of the commodity prices
Right.
have moved up, and there were some signs that you could. I'm not in that camp. I think we're gonna, I think inflation's trending down. That doesn't mean every month is going to be a downtick, but I think you're going to see inflation is going to continue to move down, and ultimately into deflation in the bust next year. But one thing that I think the Fed may find, they don't realize it yet, but I think is going to help their policy, or help them kind of pause, is that I think oil is rolling over. If oil prices are rolling over, if gasoline prices are rolling over, and both, I looked at both and they look like they are, I think you could see WTI crude head back towards the low 60s, which has been my call all along. Um, and so I think and I think gasoline is going to head south. So if we get both of those moving down, and you can see in the chart that they're rolling over, the crude's rolling over there. If it heads back down into the 60s, that's very much helpful to the whole inflation expectation story. So I'm thinking that's likely, and will offset, whatever people are worrying about in terms of other commodity prices that might rally a bit here. So I'm thinking the Fed is probably either done, or we'll do another quarter in September and say, okay, let's call it a day for a while. Doesn't mean they can't come back. That's still something I say, is that if we get the market rallying up to 6,000 or 7,000, Powell's going to probably come back in and say, hey, we got to tighten conditions. This is runaway, excessive risk taking, et cetera. But for the time being, if you get, let's say we get a pause here, they don't hike in September, things look good for October, November in terms of them being done, that's a huge wind at the back of the market. Because that's, to me, that is the biggest story out there. Is if, I'm not saying it's permanent, but if the street starts thinking it's permanent, that the tightening cycle is over, that's all you need to get a big rally going. And
Yeah, it's oh, sorry.
on top of that, I expect a weak dollar. It's been strong this week, but I think it's going to roll over. And I think interest rates are peaking here, so they will be rolling over. Interest rates meaning bond rates. So if you get those three things, Fed tightening over, or at least the sentiment that it's over, and you get dollar down sharply and rates down, I think those are the kind of things that can propel a big rally. And then FOMO kicks in, and you just keep going.
What do you make of this? So these were the probabilities I was talking to you about for the September meeting. And when you were talking about November, I peeked over there out of curiosity. This surprises me that they're talking about 47.5% probability. It looks like of a 25 basis point hike is essentially
Yeah.
priced, is priced in November. but they're looking at a pause here in September. So do you think the Fed's just trying to see how we react here and then, but otherwise they're right now potentially expecting to have like a 50-50 chance of having a hike again in November?
No, keep in mind these are street expectations. The
Right.
Fed may have a totally different view of things.
Right.
I think if you were to survey, and they're not all on the same page, but if you were to survey the bulk of the Fed members, I think you would hear um, we're going to stay at these levels for a while. It's not so much we're going to hike a lot more, but we're not going to come down. So I think you're beginning to hear some noises out of some. Harker, I think today in an interview, it sounded like he was starting to talk about um, the possibility of a cut sometime next year, in the first half of next year. He didn't define it as such, but he was giving you reasons why if you got if you got inflation down into the twos, that you could actually make the case that cuts are coming. So that was somebody else. I don't think it was Harker, but I think in the back of the Fed's mind is possibility of that. But I think generally the Fed believes we're going to remain at these levels for another year. We're not. It's not that we're hiking, but we're not going to be cutting either. The street, on the other hand, probably is looking for a cut next year, maybe a series of cuts, because I think they're more bearish on the economy than maybe the Fed is, and so that's there. In terms of November, I think that's probably the street still not willing to think that. Yeah, I think that's a little bit of what I was saying about the street thinking that inflation is going to pick up again, that maybe we are at that focal, the kind of that turning point, that inflection point where inflation's gone as low as it's going to go for a while, and then we get a number of months going the other way. That's not my view, but I think there is a street view out there of that. So I think they're kind of guarded about being able to say the pause in September is long lasting. I think they're
Right.
worried that they might go back the other way. So it's a little bit like where we were in June. They paused in June, hiked in July, paused in August, paused in September, hiked in November. I think they're not willing to think the Fed is totally done. I am. I mean, I don't, as I've said before to you, I'm not sure it really matters if we're close to done or whether we're done with the hikes. I'm more driven by bond rates, and I think bond rates are done going up. I think we are at an inflection point on interest rates on bond, 10 and 30 rates, and I still expect the 2.5% 10-year probably by the end of this year.
One of the things you brought up that I was curious about was just throwing the 30-year Treasury index real
Yeah,
fast while you're
yeah, yeah,
talking
yeah.
about it. But one of the things that I keep a pretty close eye on are those kind of the futures probabilities, to your point, from the street, and then also the Fed dot plot. I'm a stats guy, so like I like looking at data and just seeing relationships over time. Is the dot plot something that you follow and find any meaningful efficacy in? Because I have found two observable trends with the dot plot looking back over essentially the last 50 years, but not a lot of like positively correlated predictions coming from them. So I'm curious your thoughts.
Yeah, I don't put a lot of stock in the dot plot. I think the Fed has proven itself through all the years I've watched them through so many cycles. The Fed is always late to tighten and late to ease. In other
Right.
words, they stay too long on both sides, and as a result, we get boom busts. And so I just don't think there. It's economists in a committee, and obviously the dot plot is kind of the summary of all of them. It's a consensus forecast from a group of academic economists, basically. So it shouldn't surprise anybody that they're not going to be predictive. They're going to be followers, you
Right.
know. And one of my big criticisms of the Fed over the last couple of years is that they're mostly if not all, non-market people. Powell certainly, he was a private market guy as well as an attorney, and most of them are academic economists. So they don't have that market experience, and I believe that the market is the leader most of the time. Now, sometimes the market can go off on a run, and it turns out to be a false run, isn't predictive, but more often than not, the stock market, the bond market are going to lead the Fed. They're going to be leading indicators, and the Fed's a follower. So
Right.
by definition, the Fed's going to be kind of late to the recognition.
Speaking of late kind of to the party for the Fed, what do you make of the balance sheet and kind of their unwind? It started kind of in what, April 23 is when it actually started contracting a bit. But what do you make of that? Do you think that the velocity is the correct pace? Do you think that it'll have the impact that they're intending?
Well, let's put it this way. First of all, I am more or less a monetarist. I'd put myself in that category. I think money is all important, more so than interest rates. And so, the fact that they've pulled almost $1 trillion out of the off the balance sheet, pulled
Right.
out of the system, um, would normally turn me bearish. I mean, I'd normally be saying that's a, we don't see $1 trillion pulled out of we've never seen it before that to that tune. So normally I'd be bearish, but then you have to put it in context and realize right preceding this was $5 trillion added to the
Right.
balance sheet. So what they've done is taken 20% of that huge number out. And again, I think what we're seeing as we're seeing the economy stay resilient, as we're seeing, I think it surprised most economists and most of the street that the economy's hung in there as long as it has. It surprised
Mhm.
me. But I think it really, if you look at it in hindsight, what it's telling you is, and some of this hindsight, I had actually said some of this prior, um, there's so much money that got put in, unprecedented amounts of both money and fiscal stimulus. So fiscal monetary stimulus got put in 2020 and 21. That's still sloshing around out there. And that's what's allowed them to be as tight as they've been and not have it impact the way it would have. So it's why I still think there's time for a melt up. It's why I am not worried about the tightening they've done in the last year. People couldn't understand why I remained, why I kept this melt up in there. And I had one of the most bearish forecasts call for a global bust coming. But it's because there is an awful lot of liquidity, and investors, particularly institutional investors, were so positioned bearish that I said, before we get to that bust or before we get to that downside story, there's a big reaction back the other way, and that's what we're seeing. I mean, since last October, and it's just not over yet. And I feel comfortable saying there's still plenty of liquidity out there. It's not,
Got it.
unfortunately, I think a lot of particularly retail investors have kind of come to the conclusion that you need Fed stimulus to drive markets. So when the Fed's tightening, it's like, how can the market go up? And I go, the market's not, there were times where the market through, the last many decades had no monetary stimulus and had big bull markets. There's money in the system that gets redeployed into stocks at times and can drive the market. It's not the Fed. The Fed's not buying the stocks to move the market up. We don't need new money all the time to drive a bull market. But we do have a lot of money in the system thanks to what happened in the pandemic. And I think that's why you're going to get this what seems incredible, a 2,000 or 2,500 point rally in the S&P in less than 6 months.
Right. And your catalyst for the turnover after we see that kind of rapid ascension, does that remain the same or has that evolved?
No, it's the same. My time frame hasn't changed, but it also can change. In other words,
Of
I
course.
I don't have a precise time because it may sound disingenuous to say this, but the market will tell us when it's going to roll over. I can't tell you that. I can tell
Yeah.
you what I think in general terms, that I think the melt up's going to be steep and fast, so it's going to happen in a matter of months, not a matter of years. Um, the bust is going to come, I think, in 2024. I don't know whether it starts immediately early in 2024 or stretches, we stretch this thing out for a few more months beyond that. I don't think that's important. The point is that you've got what I think is going to be the biggest financial crisis, if not in history, certainly in the post World War II era, coming next year, and we're going to have a downturn that's perhaps the biggest in the post World War II era. So the thing that people have to remember is it's not all driven by the Fed either. It's a global bust. And if you look around the world, China's obviously in a place they haven't been in decades. They're slowing down fast, and they don't have easy answers because their last 20 years were driven by massive debt and liquidity. So, they can't just turn that pump on again because they got those same issues out there of huge excesses. If we just add those excesses, we create more excesses. So they're wrestling with how do we fix this, and their real estate sector is really getting hurt, and is vulnerable here. So China's a lot weaker than we are right now. Um, Europe's weaker than we are right now. Canada's got problems. Australia's a house of cards. So it's not just the U.S. We can look at the U.S. and say, well, we're, people out there talking about no, soft landing, no landing. Well, you know, I don't think we're going to be immune to a landing when you look around the world and see how much trouble is everywhere. And again, I'm not saying it's imminent. I think it's next year, but I don't know exactly when it starts.
And how do you view the cycle going? Like, do you think the US starts the decline and then the other countries follow? Or do you kind of envision a broader external contraction that then the US becomes sympathetic to and collapses with?
Yeah, honestly, don't know. I have said
Got
over
it.
for several years, I think I've said that I think there's a decent likelihood that it could start overseas. Certainly, the financial crisis will be centered, I think, elsewhere. In other words, I think our banks took such a hit in '08 and '09, and had to raise capital, and we got religion over here in terms of regulation. Our banks are better capitalized than most of the world today,
Right.
whereas the opposite was true in 2008. So I think the real vulnerable banks are more centered in Europe, maybe China. I don't, it's a closed system, so it's hard to know exactly what will happen there. China, Australia, Canada, those banks are in have greater risks than our banks. Now, our big banks, and we have plenty of risk in our, the regional banks we saw last March. There's plenty of problems here. I don't mean to say we're in great shape. The office building, commercial real estate situation is one issue, and the rapid rise in rates has kind of created some balance sheet problems for lots of banks. Um, our big banks, though, however, where we do have better capitalized, more conservatively run banks now than 20 years ago, 15 years ago, um, they still have big counterparty risks, though, with overseas banks, and it's not a closed system. So I'm not by any means assuming that we're going to skate through this. We could lose a big bank here or there, and certainly regional banks. But I do think the bigger financial crisis events are going to probably be overseas. As to what triggers it, you never know what catalyst exactly. Could be a bank. We saw how quick things can change in March. You heard on a Friday, and by Monday, you knew, Silicon Valley was in trouble and Republic was, in trouble. And so it can happen very fast. Um, You may get some, some murmurs of it a few days early, and then it hits. But I do think, it could come from a lot of different places.
One of the things you mentioned in that was just a little bit about the kind of housing, and I've been generally baffled by what I've seen in like the home builders ETF XHB compared to what I see in terms of like demand for housing right now. So like the number of homes sold across the US according to Redfin is down like 16% year over year. I was thinking maybe they're seeing some sort of broader demand. That's why builders are staying busy. But with rates still as high as it is, I don't understand enough about their production cycle. I was assuming it's a little bit longer runs. So they're expecting once rates fall, there to be maybe a surplus of demand that they're trying to meet. But I can't make heads or tails of it. I'm curious if you have an opinion on why home builders seem to be busy against a otherwise pretty damn weak housing market, at least for the residential side.
Yeah, for sure. I think it's pretty simple actually. If you're in a home that you purchased, in the last
Mm,
5, 10 years or 20 years, whenever, you're sitting, particularly the last 10 years, you're sitting on a, 3 or 4% mortgage rate, if not lower. And you're sitting there and saying, I'm not selling my house to buy another house because, right away my mortgage rate doubles or more, and I'm not going to be able to get what I want to get. So so the supply of houses on the market is being very much constrained by the mortgage rate, right? By the big rise in rates. The same thing that happened to the banks, where you had a 500 basis point rise in rates, happened to mortgage rates, and so it shut off the secondary market for, there are some homes and they are turning over, but as you've heard, I'm sure we hear, um, there's multiple buyers for these homes. You go to buy a house and there's, 3 or 4 bidders, and they bid
mhm.
over asking price, and people are, clamoring to get a house, and every time they lose out because there were 3 other people that outbid them. So secondary homes, I just say there's 17% drop in homes, secondary
Number
home
of homes
sales.
sold, yeah.
Yeah. Um, However, the home builders are subsidizing the mortgage rates, so they're offering incentives. They're saying, if you buy a home, we'll give you a 5% mortgage, or we'll give you a 4 and 3/4% mortgage, and it's coming out of their profit margin, obviously, because they have to fund it, by getting money either through the banks or through floating a bond, whatever. So they're basically, rather than doing market rates, they're doing, a much below market rate. So all these people that are lined up to buy homes are saying, I'm not going to go into the secondary market for a home because, I can't find what I want. It's overpriced. It's, every time I go to bid on one, there's 3 other people bidding on that same house. So they're able to go to these home builders, and I don't know how common this is, but I think in the big national home builders it's pretty common, and get financing deals that are attractive,
Interesting.
and and keep in mind, there's a lot of people that are fearful, this happens every housing cycle, that this is never going to end, that you're never going to see housing prices below this again. So you better buy now because they're only going to go up. So all those people that are, let's say, first time home buyers, that are scared to death that they're not going to be able to buy a house, afford a house, if they don't do it now, are jumping at the chance to get a 5% mortgage rate on a brand new house. And they're not so worried that maybe they're paying top dollar for that house. The house that might have sold for $150,000 less 3 years ago, they're just glad to get in and be able to afford the mortgage payment, even if it's high. Um,
Interesting.
so it really
Yeah.
is favoring the new home, but a new home seller, the home builders, and what you're going to find, I think, in the bust is that the secondary markets all of a sudden going to open up because you're going to have forced selling by some people, whether it be foreclosure or people have waited so long and they said, I lost my job. I can't hold on to this house or, any number of reasons. You're going to see that supply expand. You're also going to see, all those people that went into the B&B business, the Airbnb business, you know, if you're not seeing the kind of rental market you did see before, it may not be worth holding on to those things. So you're going to see that supply come back out or some of it. So I have no doubt we're going to have a down cycle. All those people that would think that's going away, I've been doing this too long and seen too many cycles. It always happens. It just doesn't happen right away. And it happens typically when everybody gives up on it happening. And that's where we're at now. So I'm pretty sure in the bust, you're going to see a down market. I'm predicting potentially 30% drop in home prices during the bust. So, what do I know? It doesn't mean it's going to be 30, but I think
Sure.
the potential is there for that kind of. There's a lot of air in home prices right now because
Right.
houses are less affordable than ever in history. I think right now, the affordability index shows them, totally out of reach of so many people. I just don't think that's sustainable.
And speaking of affordability, another thing I wanted to get your take on was just consumer spending right now. I've been tracking that pretty regularly along with, CPI, PPI, stuff like that. But the consumer spending has seemed more resilient than I would have expected. And I don't know if that's tied to the job market because job market metrics came out today for jobless claims and they actually came in at like 230 compared to 240 expected. So I don't know if maybe that's what we're seeing, but like, what do you make of just the consumer spending habits right now and how does that play out throughout your cycle prediction?
Yeah, I think what we're seeing is a have and have not economy. So again, it goes back to that whole thing of we had an awful lot of fiscal stimulus during 2021, 2020 and 21. Checks handed out to everybody, etc. I think that savings is being drawn down and is getting to the point where a lot of that excess stimulus is gone from the consumer savings standpoint. And you're seeing that in some of the signs are you're seeing credit card balances moving up, you're seeing delinquencies moving up. So I think there's a have not part of the economy that those people are even having to use a credit card for necessities. And and yet you still have all this wealth effect out there. I saw some statistic where it's something like 40 or 50% of homeowners have no mortgage because they're baby boomers or whatever held on to their houses,
Mm,
and so you've got a lot of people with a lot of equity. It's weird for me to be talking about the biggest financial crisis in history, huge downturn next year when you've got that kind of stuff. But I think it can happen. It can reverse in a hurry. So you've got to have part of the economy, have part of the consumer, not just the wealthy, but people that have plenty of equity in their homes and may have a good pension or 401k with plenty of assets in there, and those people don't mind spending. They're saying, "Hey, I got plenty of buffer. I can spend a little bit more than my income or what have you." So I think that half of the economy is fine and is just not willing to quit. The other half is trying to get by, and they're saying, at the end of the month, I don't have enough money to afford groceries.
right.
I'm not able to pay my utilities every month. I'm paying them in piecemeal or whatever. There's I think there's a chunk of the economy or a chunk of the consumer that is strapped completely, and then you've got somewhere in that middle people that are just crazy enough to say, I'm going to have $1,000 car payment, but I want that car today, and I want
Good
an
old
electric
American
car,
dream.
right? It's shop till you drop for some people, and they don't necessarily have the financial common sense to know that they're not going to be holding on to that car very long.
Right.
Something's going to happen next year that's probably going to tell them they can't make their payment. So I think we're kind of a mixed economy. And as I try to explain, when I talk about a melt up and then I talk about a bust, what people don't miss in there is that it gravitates. The melt up is about the market, so it's really melt up and bear are the two equivalents. The bust is you know an economy that's an economy that's moving up, and a bust, which is a bad economy, are the two comparisons. So it's not really melt up into a bust, it's melt up into a bear. But if you understand what I'm saying, bust refers to the economy, not the market. But people kind of use the bust and talk about the market. So people don't realize that there's something in between. Before we get to the bust, we're going to be in negative economic territory. We're going to be in recession before the bust. The bust is when the recession gets worse and the financial crisis kicks in, and all of a sudden you got banks failing, and you got a lot of involuntary debt liquidation. So there is a period, and it could start before the end of the year, that we're in negative GDP territory, either late this year or early next, but we're not immediately going into deep dive.
Got it. And one of the follow-ups I have there, just considering the broader perspective, when we get to this bust phase, what what is the duration of that look like to you? Like, what is the quality of it? Obviously not looking for, any sort of like rough or hard timeline assessments, but I'm curious like how that actually plays out in like a broad cycle perspective.
Yeah, I'm still thinking we're going to have the bust dominate 2024. So whether it starts in January, February, March, April, I'm not sure, but I think the bulk of 2024 is going to be a negative economy and a negative financial environment, very negative. Um, I think it's fast. So I've said before, I view the bust. My description of the bust is something that's can feel like a depression, but at the speed of a recession. So a recession is usually 12 to 18 months, and that's kind of what I think this will be. But I think the financial crisis kicking in, where you've got major banks dominoing across the world in failure, is what the bust is about. It's when you start wondering. I mean, go back to 2008-9. There were periods in there where you just didn't know where how long is this going to be? Where are we? We're seeing our biggest and best banks and other financial institutions, you know, at risk of going belly up. And obviously Lehman went belly up, and AIG could have gone belly up, and even GE came close. So that's as I say, 2008-9 is came very close to a bust. What I think 2024 is that next step where in the fall of 2008, the Fed acted fast, the government acted fast, and they stepped in and unfroze the commercial paper market, which was a day away from shutting GE down. If they hadn't acted fast, we probably would have seen a bust in 2008-9. This time around, I think because the excesses are that much greater, the leverage is that much greater, and there's some reluctance to do the same thing again. As you know,
Right.
that's been Powell's mantra. We're not going to do that again. We're not going to do QE again. We're not going to. So they're going to pull. They're going to be slow to do the things they're going to have to do to save the system, and it's in that time that they hesitate that things can break. If they had the mindset in 2008 that they have today, we would have seen a bust in 2008. And yet, look at the difference in the leverage today. I mean, we are at 300 trillion in debt across the globe. We were at a 9 trillion Fed balance sheet when in the fall of 2008 we were at 875 billion. I mean, the leverage is just massive, massively different. And leverage is what can move things much faster on both the upside when it's good, on the downside when things are bad. And that's what I think people don't yet grasp, is how you can see things just go, wow, how did that happen so fast?
Right.
Whoa.
Right. One of the things we talked about last time as well was metals, the way that you saw them moving. And I know that we're coming up on time here, so I don't want your metals fans coming to beat me up. Every time I forget to talk about metals, they let me know. So I refuse to forget.
Yeah,
Um,
good. I'm glad you
so
did that,
let's
because
talk about metals.
I think we're at such a great inflection point. Um, if you go back um, to 2001, um, you know, gold was at um, where was gold? Gold was
Two-
at 800,
270.
I guess. Yeah,
Yeah, down
and
here.
we ran up. You can see it ran up to 1900. We have spent all of the time since 2011, when it was at 1900, we have spent in this kind of consolidation, sideways to up consolidation. Went through a big sell off, and in 2016, early 2016, began from, I think, 1060, if I remember right,
Yep,
um,
that's right.
and began that run up. We are, it's funny because people are really kind of very down on gold and go, it's never going anywhere. Gold, and then you look at this chart and you go, my God, we're not that far off all time highs, right? I mean, we're in 1950 or
25.
wherever we are, and
Mhm.
we're 1920, 30. We're not far off all time highs. We get above 2100, and it's clear sailing. Never had a resist, never no resistance above that, and that's
Right.
why I think once you break out, we're going to be at 3,000 in a hurry. So my belief is in the next 6 to 8 months, we'll see 3,000 on gold. In the next, month or so, month or two, we should be at new highs, and then a big run from there. So my pre-bus call is 3,000 on gold. That's been my target for a long time, and it remains my target. Um, and I see nothing here that's disturbing. I hear all kinds of people talking lower. I could be wrong, and maybe we're going down, but everything points to. I think, in fact, I think we are turning as we speak. I think we turned this week, and we get down basically to 1900 again, and I think we are going to start that run to make new highs within the month, within the next month, and once we break out, you probably do a little retest back at that high, and then you just start running. Um, as I've said, I think gold probably peaks after the peak in the S&P or the peak in the equity market will probably occur prior to the peak in the metals. Metals can go far. They're starting later. They can go far longer. But I think both are pre-bust. So the peak in metals probably is sometime first or second quarter next year. And like I said, we can be in recession while the metals are still running. The bust may not hit until middle of next year. So the bust is a 2024 story, and we'll be on our way to the bust in negative economic territory, maybe right from the get-go in 2024. But that doesn't mean the bust hits right away. So you have time for this thing, and maybe it'll happen faster. Maybe we'll be at 3,000 on gold by the end of the year. I don't know that, but I think common sense says, it's likely to take longer than that. So first quarter, second quarter next year. Silver, um, same story really.
Quick, sorry, could I
Um,
ask you a quick question on gold
oh,
before we
sure,
pivot to silver?
sure.
What do you make of like these kind of three attempts at that high level in gold? Does that mean anything? I don't follow gold anywhere near as closely to you, so I'm actually like genuinely curious how you view that kind of. It seems resistance, but I'm not sure what to call it.
Yeah, it's a triple top. You could argue it's a triple top, but it's also a triple effort. Obviously, the first time up was a new high. It went to
Mhm.
2100 above that 1910, 15, 20 area back in 2011. So it made a new high there, and it's made three attempts there are two more attempts to break through that area and failed at that level each time. I think most technicians would probably tell you that third time's a charm. You tried to break out above that 2100 once. You made the high, and whenever that was, you went to break above it again the second time, and then or the next time, and then again a second time. So I think the next time third is the charm. That what you do is each time you weaken that resistance a bit, and I think you're going to push through it next time, and then just keep going. So I view that as bullish.
Yeah, it's interesting too because just from like a typical technical perspective from like trading, I kind of view exactly what you're seeing as well because I also see this was like a pretty big extension. It touched it, ran away. This one it touched it, hung out, and then now there's actually a lot of congestion building in this level, which tends to me would lead me to believe that people are starting to get more comfortable with that price. But I appreciate it. Like I said, I know you track gold pretty closely, so I was curious how to take a
Yeah,
look at that. But
and by the way, the sentiment with this sell off from 2100 down to 19 or so, a couple $100 sell off in the last you know number of months has really created people are have given up on gold. There's so many people that I run across that say, "Oh, gold will never do anything for you. Gold's a dead investment." And so it's amazing to me when you look at that chart and you realize you're not far from all-time highs, and that the pattern you see there is not something that you would think would have discouraged people so much. But that's what I see is very discouraged investors that just have no hope. They just think gold is a dead investment. I've waited too long for it. And I mean, silver's worse, but in both, sentiment is at the levels that normally precedes a big run.
yeah,
Very,
silver
very high,
seems
very high.
super flat here.
Yeah, silver's it's hasn't been able to get out of its way. You look at that great run, similar to gold from the early 2000s up to 2011, and it's been from then this long period of consolidation, and you sit there and you kind of have to you just scratch your head and go, how come? But
Right.
I'm a huge believer that what you've got is a huge consolidation, a huge base from which to build. And I think you've got my target is still $60 pre-bust, so same time horizon as gold. Um, and it's you gotta get through more resistance in silver. Obviously, there's you're a lot farther away from the old high, um, up around close to 50,
Yeah,
48, I think.
this
Um,
hit looks like yeah, like 40. It almost looks like it hit 50 on the nose.
yeah. So you've got to still work through all that there, but I think that long consolidation, a lot of those people are out already. They took losses and left. Um, and if you know, I mean, they've been smaller bounces, but the moves during the consolidation, when it goes in kind of vertical fashion. The most recent one was back in 2020 after it sold off in the early 2020 in that March 2020 sell off, but it had a huge run from there into August. And that's what I see here is, again, I think this thing can really go vertical within the next 6 months. So I think it started. I think you've basically in the very way over on the right side, you can see kind of a double bottom there, a little bit of a W. We just hit our low this week. And I think from there we move up. You got to get up above 30 first. Then I think, above 35, you're running to probably back to the old highs. And then I think you break out. So it's a big call. It's an aggressive move from here, but that's what I see. I just think silver sentiment is rock bottom.
Right. Yeah, I
And
could see
again,
that.
what drives it? Yeah, what drives it is more than anything else is a dollar. You can have rates coming down, that'll be bullish for both gold and silver, and you can have the dollar. And then I throw in that third thing, which is you all of a sudden. I think what's hurt the metals a lot is they really are hurt more than anything else by the Fed um, in tightening mode. When you all of a sudden, when the street all of a sudden decides tightening is done, whether the Fed thinks it's done or not, if the street decides it's done, you're going to see several months where you're going to see the markets, all these things run. That's a. I just don't think people realize how much of an impact Fed tightening has had. Taking that away becomes a huge wind at your back.
It'll be interesting too to kind of see things that I think retail traders tend to view as not inversely correlated, but in general, people tend to expect the market to go up and then, metals to go down and vice versa as people are flight to equity and whatnot. So it'll actually be really fascinating to see all of them moving in the same direction, essentially, if your prediction plays out as you see it does.
Yeah, it's interesting. I said this week we're at inflection points on so many things. I think interest rates are at an inflection point, and I'm calling for big down. Yeah, obviously 250 on the 10-year, maybe by the end of the year. That's a big move, and nobody else is looking for anything like that. In fact, most are looking up, not down. The 30-year I think can get to two time frame. And again, those are just during the melt up phase. During the bust phase, I'm calling for 10-year to go to zero or negative. So, so in other words, from here, you're not going to see higher rates. You're going to see much lower rates over the course of the next year. So that's a big inflection point in rates if I'm right. Big inflection point in the dollar if I'm right, even though I think the dollar is very close to a rollover, and with dollars at 104 essentially, I think, or close to it, and I think it can get down to 80. That's a big 24-point drop before the bust, or early in the bust. Maybe they'll keep going. And then you got equities and you got metals, at major turning points here, whether it's right here or in the next week or two. Um, uh, it just seems like everything's coming together. And the thing that I think kind of brings it all to that point is the Fed.
Mm.
And yeah, people ask me all the time, if the Fed hikes in September, does that change your view? I go, no, I'm not worried about whether they're absolutely done. I think the narrative that will be coming in this fall will be that the Fed tightening cycle is ending. Not necessarily ended, but ending.
And that enough would be kind of the feel that you see.
Yeah, again, if you think the Fed cycle, the tightening cycle, which started, year and a half ago or a year and a few months ago, if you think it's over, usually Fed tightening cycles, once they end, they're over for several years, right? So that means you got wind at your back for several years. Now, my view is that they'll probably come back in maybe as soon as a few months later and say, oh my God, the market's up at 6,000. We got to tighten. So I'm not saying it's over, but if the street
Right.
believes it's over for a few months, who am I to argue that, or who is anybody to argue that? If the Fed even thinks it's over, um, then that's what will be the narrative for that period. It will change back to a different narrative if the Fed has to come back in,
Got
and
it.
then it's time to get bearish.
Well, as always, I know we're up at time here, but it's fascinating. It's fascinating to look at the markets and the economy through your lens. So thank you for taking the time, right, to share your experience with us, what you're looking at, the relationships that you see. I think it's super informative for people. So before we wrap up, though, I'll make sure to throw a link to your Twitter, which is at Dave H Contrarian, and I'll have that in the video description. There's a lot of fake yous out there, so we'll get the real you in front of folks. And then, is there anything else that you want to share with the folks before we wrap up here?
Yeah, just to say, if we're going to get what I just talked about, this is going to be a heck of a fall. I mean, and people are just going to have to keep their wits about them, because it's not something that's going to be sustained for several years. It's something that will happen fast, be amazing, be compelling, but also be, don't let your emotions get away from you, because it can, you can easily get sucked in.
Mm.
Obviously, it's a forecast, so I can't guarantee it's happening, or I can't, I could be wrong. But if what I see, and I'm, as I say, it's a high conviction call for me. If I see what I think I see, this next several months is going to be a period for the history books.
Mm.
Um,
Well, I'll tell you what, for the options traders out there, that just delights me because as soon as we start seeing volatility, that's bread and butter right there.
yeah,
So,
let me caution because as I say on Twitter, I'm a strategist and I forecast. I don't provide advice. I don't recommend. The people that have the hardest time with me are the short-term traders.
of course,
My history is I'm early or things get stretched out.
sure.
So the people that probably hate me the most are options traders because I can talk like it's coming imminently, and then it takes longer, and I just chalk that up to the
Yeah.
market. They're in charge, not me. So I just caution, if you have a lot of options guys following this, um, give yourself plenty of time in those options because 3 months may not be how fast it happens.
Sure.
It could take longer.
And one of the things that I always talk to specifically options traders about, or just any trader, is the idea, at least in my opinion, isn't as a retail trader. It's not to pinpoint any sort of pivot. It's to ride the broader wave and take
Right.
60, 80 points out of it, right? Like there's tons of money to be made in there, which is directly to your point. I find the people that get frustrated at you are honestly just lazy and they want somebody to hand them tradable information that's completely accurate and they don't have to think, which unfortunately or fortunately, depending on how you look at it, is not how the markets work.
Yeah, and if not lazy, at least um, naive and probably in a market they shouldn't be in. Meaning, if they're playing options, I mean, they're looking at it as easy money, and more than I do that options are not easy money. You better know your stuff because it takes the money from the best of us in that business. I
Yeah.
mean,
Yep.
it's too easy to be a gambler in the stock market because you see the potential. What you're missing is the risk. The risk
Yep.
is bigger than the potential, and you better understand the risk before you go in.
Yeah. What I tell people is if you trade options compared to equities, in equities, you got to get one thing correct, direction. And options, you got to get three things correct: direction, time frame, volatility. So you've just added a ton of complexity to that same assumption.
Yeah, I would say 90% of people playing options shouldn't be there. That's based on
Concur.
what I see in the tweets and stuff I see. I just think so many people are over their heads.
Yep.
And then they can't look in the mirror and blame themselves. They got to look for some scapegoat. It's got to be somebody else that's caused them to lose their money.
Of
Um,
course. That's the best thing is never your fault, right? If
right,
yeah.
right. Yeah. So,
Well, awesome, David.
yeah,
Oh,
thank you
sorry.
for having me. I will just mention I do have the investment letter that I put
Sure.
out quarterly. People can, if they have interest in it, they can direct message me on Twitter, and I'll provide them details. I don't talk about it on Twitter, so just these are the only places I really have a chance to at least let people know I do have
Yeah,
an
for sure.
investment letter.
Awesome.
So
Yeah. So then, for anybody listening, if you want to check it out, make sure you look in the video description below. I'll have a link to his Twitter. His DMs are open. So you can, connect with him there. And then, yeah, until next time, David, absolute pleasure. Thanks for hanging out for a bit.
yeah, thanks, Eric. It was fun.
Take
Take
care.
care.